What's going on, guys? My name is Jason and welcome back to the channel. If you haven't already, be sure to hit the subscribe button so you don't miss out on future content. And with that being said, in today's video, I'll be going over the crazy weeks we've been having in the stock market and how you can protect your money from future corrections or even a crash. If you've clicked on this video, then I'm sure you've been following the news and what's been going on the past few weeks. And there are many different things that are making the market behave the way it is. But obviously, as we all know, the main reason being the coronavirus. Because a lot of companies do their business overseas. And for those of you that are new to investing, there's really no need to panic. In my opinion, I feel like the news channels just need some glorifying headlines just to make a couple dollars. So what do? Well, they have to link the coronavirus to something, right? What better than the stock market? Now, if you've been watching the market for a while or have been invested in it for a while, then you know it's been having a really good run and has been making new highs for a while now. And while that's all good and you're seeing a lot of profit, this is a well-needed correction that the market needs. Now, this doesn't mean that you should panic and sell everything and hold on to cash. And I think it's a perfect time for you to go ahead and pick up some stocks that you probably thought that were overpriced before. So let's get into a few ways that you can protect yourself during this so-called crash. Okay, so the first way that you can protect yourself is through diversifying your portfolio. Now, there's different types of investments or even strategies that you can implement towards your portfolio, in which it can help minimize your total loss. You can start by using investments such as bonds, short-term investments, international stocks, sector funds, commodity-focused funds, and real estate funds. So let's quickly go over the investments that I just mentioned and see how they can help you minimize your losses during a correction or a stock market crash. Most bonds provide regular interest income and are generally considered to be less volatile than stocks. They can also act as a cushion against the unpredictable ups and downs of the stock market, as they often behave differently compared to stocks. Short-term investments include money market funds and short-term CDs, also known as certificate of deposit. Money market funds are considered conservative investments that offer stability and easy access to your money, ideal for people who are looking to preserve their principal. International stocks are usually issued by non-US companies, and they often perform differently than their US counterparts, and they also provide exposure to opportunities not offered by US securities. Now, sector funds invest in stocks, and this could be a valuable tool for investors who are looking to seek opportunities in different phases of the economy cycle. Commodity-focused funds are considered to be more for experienced investors. However, adding equity funds that focus on commodities such as oil, gas, mining, and natural resources. And this could provide a good hedge against inflation. Real estate funds including real estate investment trusts, also known as REITs, which can also play a huge role in diversifying your portfolio and provide you with the protection against the risk of inflation. The second way you can protect yourself is through dollar cost averaging. By utilizing this strategy, you can protect yourself from massive price drops with just simply buying a stock regularly. This way, you're not dumping all of your money all at once into a stock and then it plummets. With dollar cost averaging, you eliminate the thought of timing the market. Instead, your returns will be calculated by the overall trend of the stock. Now, I've made a video on dollar cost averaging previously, so I'll link it up above for you to check out. So let's go over an example. Let's say you bought a stock at $50 and say you invested $5,000 upfront, and then all of a sudden the price drops to $45. And now all of a sudden you're panicking because you're down $500, which to a new investor is pretty scary. But with dollar cost averaging, when you see uncertainty in the market like we have in the past weeks, if you bought the same stock at $50, but this time instead of putting $5,000 all up front, let's say you put $500 or even $1,000 and then the price drops to $45. You can then go ahead and buy a few more shares with another $500 or $1,000. This way you're protecting yourself from massive price drops. Okay, so the third way you can protect yourself from the stock market crash or correction is through setting up stop losses. Stop losses can literally save you from blowing out your whole account. This can actually help limit how much money you'll actually lose during the stock market, or if you'll lose any at all. So let's use the same example that we used in the previous point. Let's say you bought a stock at $50, and at that time the market was doing absolutely amazing. And you're super excited, so you invest $5,000. And then let's say after a couple of years, the stock jumps to $60. And all of a sudden, there's uncertainty in the market. And like we've seen in the past few weeks, the stock you bought decides to drop to $45. You would have went from making $1,000 to now being negative $500. But if you had set a stop loss at, let's say, $50 or $55, this would have actually protected you in either breaking even or having a bit of profit. And when that market correction or crash comes along, you can buy the same stock at a discounted price. Now, sometimes obviously greed can take over, and in the end, it actually may end up hurting you. So be sure to have your stop losses in place. And just like always, if you're enjoying this video so far, be sure to give it a thumbs up so I know to make more videos like this in the future. And of course, be sure to gently tap that subscribe button so you don't miss out on future content. Okay, and the fourth way you can protect yourself is through setting up an emergency fund for yourself. I won't spend too much time on this because it's self-explanatory, but depending on the type of investor you are, this may or may not apply to you. With any extra cash that you have laying around or you're continuously saving more money, you can put your money in something like a high interest savings account for the short term and have that as your emergency fund, just in case the market takes out a stock that you've been invested in. This way you already have a bit of savings built up and you can have access to your funds right away when you need it. And if you happen to see a stock at a discounted price, you know exactly what to do. Buy some more. And obviously you can do that by dollar cost averaging. The fifth and final way you can protect yourself is through reevaluating your holdings. And this is to simply review the stock holdings that you currently have. And you should ask yourself, why are you really invested into this stock? And if you can't think of a good enough reason other than just price, then it actually may be time to let that stock go. Let me give you an example. Imagine back in 2008 if you were invested into Netflix and Amazon, and when the market fell 38%, just because you cared about the stock price, you would have lost out on a once-in-a-lifetime opportunity. Because look at the stocks now and where they are. So be sure to stand behind stocks that you actually believe in. And it's so easy to get caught up in the hype of everyone talking about stocks, this and that. Just focus on what you believe in for the stock. And with that being said, I hope you enjoyed today's video. And don't forget to give this video a like if you enjoyed what I talked about today. And also be sure to subscribe to the channel so you don't miss out on future uploads. And just like that, guys, I'll see you on the next one.